January 2025. A routine index adjustment triggered the most coordinated warning campaign the silver market had seen in years, but something didn't add up. While institutions screamed sell, physical metal was quietly disappearing from Western vaults. While analysts called it a meltdown, strategic buyers in the East were accelerating purchases. The Bloomberg Commodity Index wasn't the real story, it was the cover story. What happened in those 48 hours revealed a fragility that most market participants still refuse to acknowledge, a system operating closer to its breaking point than anyone publicly admits. This is not about silver prices, this is about leverage, liquidity, and who controls the marginal ounce when the music stops. On January 6, 2025, traders across global commodity markets noticed something unusual. The silver market was moving, but not in the way markets typically move. Prices dropped 3% in less than 2 hours. Yet the drop felt orchestrated, calculated, deliberate. Within minutes, institutional research reports flooded trading desks. Each one carried the same message. Massive selling pressure ahead. Unavoidable liquidity event. Prepare for significant downside. Experienced market analysts paused. They had seen index rebalancing events before. This was different. The language was different. The urgency was different. Bloomberg terminals lit up with coordinated warnings about the Bloomberg Commodity Index's annual rebalancing. Financial media outlets published nearly identical headlines within hours of each other. Silver faces $6 billion selling wave. Index forced to dump positions. Commodity meltdown imminent. Retail investors read these warnings. Many of them sold their positions immediately. They believed they were protecting their capital. They believed they were acting on privileged information. They did not realize they were providing liquidity to someone else's strategy. Meanwhile, professional traders were watching something entirely different. Physical silver dealers reported no change in demand patterns. Premiums on silver bars and coins remained elevated. Delivery times for industrial quantities showed no improvement. The disconnect between paper market panic and physical market calm was striking. In New York, futures traders observed unusual order flow patterns. Large block sales appeared, absorbed quickly, then prices stabilized. In London, bullion banks noted persistent buying interest from Asian counterparties. In Shanghai, physical silver imports accelerated despite Western market weakness. The narrative said the market was collapsing. The data said something else entirely. Seasoned commodity analysts recognized a familiar pattern. They had seen this before in oil markets, in copper, in agricultural commodities. When mechanical selling from passive systems meets strategic buying from physical users, the outcome is rarely what headlines predict. The Bloomberg Commodity Index had indeed announced its rebalancing schedule months earlier. This was not secret information. Professional market participants knew about it since October 2024, yet in January it was suddenly presented as breaking news, as a crisis, as an emergency. Why? The answer lay not in the rebalancing itself, but in what had happened to silver prices throughout 2024. Silver had gained 45% over 12 months. It had outperformed nearly every other commodity in the index. This appreciation created a mathematical problem for passive investment systems. When one component grows much faster than others, the system must reduce its exposure, not because the asset is weak, but because the rules demand proportional balance. The Bloomberg Commodity Index operates on rigid mathematical formulas. It does not analyze market conditions. It does not forecast future trends. It simply executes predetermined adjustments on a fixed calendar every January, without exception, regardless of market environment. This mechanical nature makes it predictable, and predictability in markets creates opportunity. By early January, silver represented nearly 7% of the index's total value. Its target weight was only 4%. The gap had widened throughout 2024 as silver prices climbed. Now the system required correction. The index had to sell approximately $6 billion worth of silver futures. This number circulated through trading floors and investment committees. $6 billion? It sounded enormous. It sounded like a flood of selling that would overwhelm the market. But experienced traders asked different questions. How much of this selling had already occurred? Who knew about this months ago? Who had positioned in advance? And most importantly, who was waiting on the other side? The answers to these questions would reveal the real story. A story about leverage, about timing, about who understands market structure and who simply reacts to headlines. The January event was not a beginning. It was a culmination. The pressure had been building for months. What happened on January 6th was merely the moment when that pressure could no longer remain invisible. When the system revealed its fragility through the intensity of its messaging, when institutions showed their hand by trying too hard to control the narrative, strong markets do not need persuasion. They do not require coordinated warning campaigns. They simply move based on supply and demand. The fact that this event demanded such elaborate framing told experienced observers everything they needed to know. Something beneath the surface was stressed, and that stress was about to become visible to anyone paying attention. The Bloomberg Commodity Index is not a trader. It is not an analyst. It is not even an investment strategy in the traditional sense. It is a mathematical formula wrapped in institutional legitimacy. $40 billion follows its instructions, without question, without hesitation, without human judgment. This makes it predictable, and in financial markets, predictability is power. The index was created in 1998 with a simple mission: provide diversified exposure to commodity markets through a single investment vehicle. Fund managers could buy the index instead of trading 23 different commodities individually. Pension funds embraced it. Insurance companies allocated billions to it. Sovereign wealth funds made it a core holding. By 2025, it had become one of the largest passive commodity allocations in existence. But here is what most investors never understood. The index does not care about market conditions. It does not analyze supply and demand. It does not respond to geopolitical events or economic data. It simply rebalances every January according to preset rules. These rules are absolute. Each commodity receives a target weight based on production volumes and trading liquidity. Gold gets approximately 15%. Crude oil gets roughly 20%. Natural gas, copper, corn, wheat, each has its assigned percentage. Silver was allocated 4.2%. Nothing more, nothing less. When prices change throughout the year, these percentages drift. A commodity that appreciates significantly begins occupying more space in the basket than the rules allow. The system detects this deviation, and every January, it corrects automatically. In 2024, silver did not drift slightly. It exploded. By December, silver had gained 45%, while most other commodities remained flat or declined. This appreciation pushed silver's effective weight from 4.2% to nearly 7%. The mathematical requirement became clear. The index had to sell enough silver to restore the original 4.2% allocation. With $40 billion under management, this meant liquidating approximately $6 billion in silver futures. $6 billion? That number echoed through commodity trading floors in New York, London, and Singapore. It sounded catastrophic, but sophisticated traders understood something the public did not. This rebalancing was announced in October 2024. The exact methodology was published. The timeline was transparent. Professional market participants had months to prepare, and they did. Throughout November and December, proprietary trading desks quietly reduced their silver positions. They sold into strength while silver was still climbing. They distributed their exposure across time when liquidity was abundant. They used the rising market to exit without creating visible downward pressure. By the time January arrived, much of the anticipated selling had already been absorbed. What remained was the residual flow, the portion that could not be accelerated, the trades that had to execute on schedule. This residual represented perhaps $2 to $3 billion in concentrated selling. Still significant, but not the $6 billion figure being circulated in headlines. Yet the narrative presented it as if all $6 billion would hit the market simultaneously, as if sophisticated institutions had done nothing to prepare, as if this mechanical, predictable event was a surprise shock. Why would experienced market analysts frame it this way? Because they needed something from the market. They needed counterparties. They needed liquidity. They needed people to sell into the fear so that strategic buyers could accumulate at better prices. The index itself was indifferent to this manipulation. It simply executed its mandate, selling according to formula, blind to price, sentiment, or strategy. But the entities surrounding the index were not indifferent. They understood that a visible mechanical seller creates opportunity, not for those who panic and sell alongside it, but for those who wait patiently and buy from those who panic. This is where the game within the game emerged. The index rebalancing was real. The selling pressure was legitimate. But the way it was framed, and the urgency with which it was communicated, the fear it was designed to trigger, that was strategy. That was positioning. That was experienced capital exploiting the predictable behavior of passive systems and uninformed participants. The machine was doing exactly what it was programmed to do. What mattered was who understood the machine well enough to profit from its predictability, and who simply reacted to the noise it created. By mid-January, the answer would become clear. But while the machine executed its programmed instructions, a very different game was unfolding beneath the surface. A game that separates institutional winners from retail losers. A game that most market participants never see until it is too late. In trading rooms across Manhattan, a quiet observation was being made. Not all selling is created equal. When a pension fund sells because it needs cash for retiree payments, that reveals market stress. When a hedge fund sells because its risk models signal danger, that reveals conviction. But when the Bloomberg Commodity Index sells, it reveals absolutely nothing. The index was not abandoning silver because it lost confidence. It was not forecasting a price collapse. It was not responding to negative economic data. It was simply following instructions written into its programming years ago. This distinction matters more than most investors realize, because forced sellers create opportunities for strategic buyers. And in January 2025, strategic buyers were everywhere. They were just invisible to those watching price charts. Throughout December, something unusual had occurred in position reports. Large commodity trading advisors had reduced their silver exposure by 35%. These were not panicked exits. These were calculated gradual reductions executed during silver's price rally. They sold into strength, distributed across weeks, avoided creating downward pressure. By early January, these institutions had transformed from net long to nearly neutral. Their risk had been managed. Their profits had been secured. And now they sat with capital, waiting. What were they waiting for? They were waiting for the exact event that terrified retail investors. They were waiting for the forced mechanical selling that would temporarily push prices lower. They were waiting to buy back the positions they had sold at higher prices. This is the iron law of sophisticated market participation. Sell when others are buying with emotion, buy when others are selling with fear. The index rebalancing provided the perfect catalyst for this reversal, but something else was happening simultaneously, something that would prove far more significant than any index adjustment. While paper markets in New York and London showed selling pressure, physical markets in Asia showed the opposite. Silver refiners in Switzerland reported record orders for 1,000-ounce bars destined for Chinese vaults. Indian jewelry manufacturers increased their raw silver purchases by 40% year over year. Dubai Precious Metals dealers noted unprecedented demand from institutional buyers across the Middle East. The disconnect was stark. Western financial markets treated silver as a trading instrument to be bought and sold based on technical signals. Eastern physical markets treated silver as a strategic material to be accumulated and stored. This divergence revealed two completely different investment philosophies colliding in the same market. One side viewed silver through quarterly performance metrics. The other side viewed silver through decade-long industrial planning horizons. China's State Grid Corporation had announced plans to install 500 gigawatts of solar capacity by 2030. Each gigawatt requires approximately 30 tons of silver. This created a non-negotiable demand baseline of 15,000 tons annually. India's electronics manufacturing initiative required securing stable silver supply chains for component production. Their government had authorized strategic stockpiling of critical industrial materials. Silver qualified as critical. These were not speculative positions. These were infrastructure commitments backed by national budgets. When prices dipped due to Western index rebalancing, these buyers did not panic. They accelerated. Because, from their perspective, temporary price weakness in paper markets meant one thing: cheaper acquisition costs for physical material they would need regardless of price. And here is where the structure of modern commodity markets created a dangerous asymmetry. Western exchanges operate on fractional reserve principles. For every ounce of physical silver in COMEX warehouses, there exist approximately 100 paper claims. This system functions smoothly as long as most participants settle in cash rather than demanding delivery. But when physical buyers insist on taking possession, when metal leaves warehouses and enters industrial supply chains permanently, the pool of available inventory shrinks, and the paper claims become increasingly difficult to satisfy. January's price action obscured this critical development. Headlines focused on selling pressure, but beneath that pressure, metal was migrating, from Western vaults to Eastern factories, from financial circulation to industrial consumption, from speculative holdings to strategic reserves. Once this migration occurs, it does not reverse. A silver bar melted into a solar panel does not return to a trading vault. An ounce stored in a national reserve does not re-enter commercial markets. This one-way flow was accelerating, and the index rebalancing, rather than signaling weakness, was providing strategic buyers with their best entry opportunity in months. The machine was selling, but the question was never about the machine. The question was always about who was buying from the machine and why they were buying with such conviction. This shift in metal ownership was not just changing market dynamics, it was exposing systemic vulnerabilities that had been building for years. Vulnerabilities that most market participants refused to acknowledge until they became impossible to ignore. The intensity of January's narrative campaign revealed something critical. When routine events require extraordinary persuasion, fragility is present. Strong systems do not need to convince participants, they simply function. But the silver market in early 2025 was not functioning from a position of strength. It was operating with razor-thin margins for error. Data from the Commodity Futures Trading Commission told a troubling story. Commercial traders held near-record short positions in silver futures. Banks and bullion dealers were net short by over 400 million ounces. This represented roughly 40% of annual global silver production. These positions were manageable when physical supply was abundant, when inventory buffers provided flexibility, when leverage could be rolled indefinitely into future contracts. But conditions were changing. COMEX registered silver inventories had declined 35% since 2023. What once stood at 350 million ounces had shrunk to 225 million. Meanwhile, industrial demand was accelerating, not declining. Solar panel manufacturing alone was projected to consume 200 million ounces annually by 2027. Electric vehicle production added incremental demand each quarter. 5G infrastructure build-out required silver in every base station and component. The mathematics were straightforward. Demand was rising structurally. Supply was tightening physically. Yet paper market positions assumed infinite flexibility. This is where the fragility emerged, not in any single event, but in the cumulative erosion of system resilience. Every index rebalancing that transferred metal from west to east reduced available float. Every strategic stockpiling initiative removed ounces from commercial circulation. Every solar panel manufactured locked silver into permanent industrial use. The system was not collapsing, it was narrowing, and narrow systems react violently to disruption. Consider what happens when the next rebalancing event arrives in January 2026, or when a major refinery experiences operational disruption, or when geopolitical tensions restrict cross-border metal flows. In a market with abundant inventory, these events create temporary volatility. In a market already operating near physical limits, they create discontinuous price movements. This is the warning that January 2025 provided. Not that the system had broken, but that the distance between normal function and critical failure had shortened dramatically. The institutions that orchestrated January's narrative understood this. Their urgency was not about a $6 billion rebalancing. It was about time running out on their ability to manage exposure quietly. Every cycle of forced selling followed by strategic physical buying tightened the noose. Every ounce that migrated east reduced their flexibility west. They could still roll positions forward. They could still manage margin requirements. They could still maintain the appearance of control, but the cost of maintaining that control was rising, and costs that rise exponentially eventually become unsustainable. For business leaders and strategic decision makers, January's event offered clear lessons. First, understand the difference between forced sellers and discretionary sellers. Forced selling creates opportunity, not risk. Second, recognize when narrative intensity exceeds event significance. When persuasion replaces price action, someone is positioning. Third, watch physical flows, not just paper prices. Metal migration reveals conviction that chart patterns cannot. Fourth, appreciate the power of time horizons. Those who think in quarters lose to those who think in decades. The silver market's January disruption was not unique. Similar dynamics were building in copper, lithium, cobalt, and rare earth elements. Any commodity essential to energy transition and industrial modernization faced the same structural tension. Paper markets created infinite claims. Physical reality provided finite supply. These two forces were on a collision course. The collision would not happen all at once. It would happen in episodes, in disruptions, in moments when routine adjustments revealed underlying stress. January 2025 was one such moment. It passed without systemic breakdown, but it left the system weaker, not stronger, with less inventory buffer, with tighter physical supply, with more concentrated short exposure, with fewer options for managing the next disruption. The machine behind the headlines would continue operating. Indices would rebalance. Futures would roll. Prices would fluctuate. But beneath the surface, the game had changed. Strategic capital understood that physical assets were becoming more valuable than financial promises, that supply chains were more critical than trading algorithms, that control of material trumped control of narrative. January's message was clear for those paying attention. The system had not collapsed, but it had revealed itself. And what it revealed was a structure operating closer to its limits than most participants realized. In the months ahead, every subsequent stress test would matter more than the last. Every forced sale would find fewer willing counterparties. Every narrative would require more intensity to maintain effectiveness. This was not a prediction of imminent crisis. This was recognition of a system in transition, from abundance to scarcity, from flexibility to constraint, from financial dominance to physical reality. Those who understood this transition would position accordingly. Those who dismissed it would provide liquidity to those who did not. The choice, as always, belonged to those willing to look beyond the headlines and see the machine underneath.